All right, let's talk about something that sounds super intimidating: financial modeling. You hear that phrase and you probably picture Wall Street geniuses and crazy complex spreadsheets. But what if I told you it's not some dark art? It's actually just a really smart way to make better financial decisions. So let's pull back the curtain and demystify this thing together.
Okay, picture this. There's a stock. It's trading at 100 rupees. You've done your homework, you're confident it's really worth 120. But your friend, they're just as sure it's overvalued and should be at 90. So you're saying buy, they're saying sell. It's a total standoff. How do you get past just arguing about it? Well, this is exactly where financial modeling steps in. Think of it as the neutral referee in the argument. It's a way to take your opinion, your friend's opinion, and ground them in reality. You use the company's actual data to build a forecast, which turns a gut feeling into a structured, data-driven case.
Honestly, at its heart, a financial model is kind of like a super-powered calculator. That's it. You feed it your assumptions about growth, about costs, about the market, and it crunches all those numbers to spit out a clear answer, like what the company's actually worth. It's a machine for turning "I think" into "here's what the numbers predict."
So, here's our game plan for the next few minutes. First, we're going to walk through the 6-step blueprint for building any model. Then, we'll talk about where you get your hands on all the data, the ingredients, if you will. After that, we'll dive into the art of forecasting. And finally, we'll see how this all comes together to make actual, real-world decisions.
All right, let's start with the foundation. You see, financial modeling isn't just diving into a spreadsheet and hoping for the best. No, it's a discipline. It has a very clear, structured process, and this 6-step blueprint is basically your roadmap from a blank page to a powerful conclusion.
It all starts with defining your purpose, like why are you even building this thing? Then you gather your info and figure out the company's key drivers. And get this, you don't even start building the actual model until step 5. All that prep work is what really matters, and it all leads up to that final crucial step, presenting what you found.
Okay, so step 2 is collecting information. But where do you get these ingredients for your model? Well, for public companies, a ton of this data is just sitting out there, totally available as long as you know where to look.
The absolute best places to start are the company's own annual and quarterly reports. They're packed with info. Investor conference calls are also gold mines. You get to hear directly from management about their strategy. After that, you can check out industry reports and equity research. Now, if it's a private company, it's a different story. You'll have to rely more on things like client interviews because their data isn't out in the open.
And this brings us to something absolutely critical: identifying the key drivers. See, you don't need to forecast 1,000 different things. You just need to focus on the handful of metrics that truly move the needle. For a retailer like DMart, it's all about sales per store and how many stores they have. That's what drives revenue. For Netflix, it's active users and the cancellation rate. That's the lifeblood of their business. For a hotel, it's occupancy and room prices. Nailing these down is what separates a sharp, useful model from a confusing mess.
All right, now we're getting to the part that most people find the most challenging, but also the most interesting: forecasting. This is where modeling stops being a pure science and really becomes more of an art. It's about blending hard data with a deep understanding of the business itself.
Just think about it this way. Trying to forecast the future for a massive, stable company like Nestle? It's pretty straightforward. Their growth is predictable. But trying to forecast for a tiny, early-stage startup? That's way, way harder. You're dealing with huge uncertainty and no real track record. The stability of the business makes all the difference in how reliable your forecasts can be.
So let's say you're building your model, and you punch in a number for next year's growth, a nice, optimistic 30%.
But then, you have to stop and ask yourself the big question: is that number even reasonable? I mean, for a company the size of Nestle, a global giant operating everywhere, can it really grow its main business by 30% in a single year? Probably not. The number of people who buy their products isn't growing that fast. All of a sudden, that 30% feels kind of crazy.
And that's the whole point, right? A good forecast isn't about some complicated math formula. It's about making smart, justified assumptions that are locked into the reality of that business and its industry. If your assumptions are wild, your model's worthless. Simple as that.
Okay, so we've built the model, we've forecasted the future. Now for the payoff. What do we actually do with this thing? Because a financial model isn't just some academic project. It's a tool that's built to drive decisions and to tell a powerful story.
And the people using these are making some seriously high-stakes decisions. We're talking about investment bankers using them for billion-dollar mergers, portfolio managers using them to pick stocks,
VCs deciding whether to pour millions into a startup. Even the company's own management uses them for their internal financial planning.
And this right here gets to the absolute heart of it. A model can spit out any number you want, but a conclusion that people will actually trust, that needs to be backed by two things: solid reasoning behind your assumptions and the numbers that result from them. If you don't have both, you're just guessing again.
Which is why this last step, the presentation, is so incredibly important. I mean, you could build the most perfect, elegant, sophisticated model in the entire world, but if you can't explain what you found in a clear and compelling way, the whole thing was a waste of time. It's the story you tell that gives the numbers their meaning.
So, I'll leave you with this one question. A financial model will always give you a number, a valuation, a growth rate, whatever. But the real skill, the true power of doing all this work, is in the story you can build around that number. What's it really telling you about the business, the industry, and the future? That's the real game plan. Thanks for joining me.